One of the things that you have to remember anytime we're going to discuss mistakes traders make, this is probably just as much about mistakes that I've made personally than it is anything else. You know, any trader who says they don't make mistakes, well, you know, obviously that's not true. Hopefully, if you're progressing through your trading career, you're making fewer mistakes, or at least you're identifying them either right during the time you're making the mistake or shortly thereafter. Obviously, identifying them is the first step, which is why one of the most popular articles you'll ever find is mistakes traders tend to make. What are the top 10? What are the top 50? There's probably 200 plus, right? I'm just going to pick 10 of my favorites, and we'll start with that. Okay? So, as we go through the list, I'm going to try to use live examples in the market to explain what I'm talking about, and if you have questions, go ahead and type them in. Okay? This is not a real formal, real complex discussion. It's really one I hope that you'll have some questions for me so we can have a little give and take. So let's start off with number 1. Now, this isn't in any particular order. This is by no means a comprehensive list either. These are just, again, 10 of them that probably are coming to mind right now because I might have made some of these mistakes. People that I talked to in my chat room might have made some of these mistakes. These are probably something that I've dealt with through some, recent discussions with traders. So that's why they're in my mind. Okay. So the first one we're going to talk about, the first one here on my list, and I do a lot of writing throughout the trading day, not necessarily journaling, but writing a lot of notes. Obviously, writing down my setups, having an action list, having a current position review for my book, the articles that I'll write on any given day. So I really do live out of a little notebook every single day, and these are the top 10 that I kind of wrote down throughout really the last 2 trading days. The first one is understand the 3 analysis types and respect all 3. Now, I used to make a huge mistake when it came to this early on, and I'm actually going to go ahead and open up the WordPad here. Like I said, I'm not a huge fan of PowerPoint, but I love taking notes, and I love sharing these notes with you all. And number 1, as you hear the clickety-clack of my keyboard, again, understand the 3 analysis types and respect all 3. It's kind of tough, the second half of that conversation there, respecting all 3. What are the 3 analysis types? It's not terribly difficult. There is technical analysis, and when I talk about technical analysis, this is really quite subjective. I know a lot of people are huge technicians, and I'm sure some of you will disagree with some of the points I'm going to make tonight, which is cool. I'm not here to say this is the end-all, be-all. This is just my reality of being in the markets for 2 decades, of teaching traders for the better part of about 15 years all over the world, literally doing webinars and seminars and writing books and teaching in front of literally thousands of people. This is just my experience teaching others. Okay? Technical analysis is subjective. So I'm talking about trend lines. I'm talking about Fibonacci. I'm even talking about pivots, chart patterns, any indicator. And the reason I say it's subjective is they're open to interpretation. The settings can be very, very different. What if I have someone who's using a stochastic on a 14 setting versus 21? Who's right? They're going to get very different readings. Subjectivity. Trend lines. Well, depending upon which touch points you choose, 5 different people might have 5 different sets of trend lines. How much time you include on your chart. If you're looking at a 5-minute chart, is it a 5-minute trend line, a daily trend line? Again, there's a lot of subjectivity when it comes to technical analysis, and that simply is not discussed enough. Technical analysis has a lot of relevance when it comes to where we decide there might be a decision level at which the market could accelerate through, stall at, or reverse from. But ultimately, using technical analysis alone will leave you severely lacking at a very complete look at the market. So then we have what I consider to be price-based analysis. And that means looking at static levels. Static levels like major and minor psychological levels. Everyone can agree that the market could be reaching a double zero or a 50 pip level. These are levels at which they have order flow relevance because people tend to place orders at whole round numbers such as the double zero or the 50 pip. I don't care if it's Forex futures or equities. I don't care if it's options. Strike prices are typically major psychological levels, whole round numbers. Price-based analysis, depending upon how you use it, is a little bit more objective, but the reason it is more objective than, say, technical analysis is we may not agree about where a Fibonacci might be. We may not agree about where a trend line might be, or whether or not a pattern has formed, or whether an indicator is indeed registering momentum, overbought, oversold, depending upon all the different settings we could use. But all of us can agree that a market is trading at a double zero, whether that be the 1.300 level of the euro-US dollar, or whether that be the 78 level of the dollar-yen. We can agree about these levels because more or less prices will be reaching that, and everybody can see within a few pips the same thing. Okay? The other reason I like price-based analysis, and I mentioned order flow, is the way in which we place orders, the way in which stops are hit, and then these orders are filled. You might call it running stops, but it really is just the filling of orders. That can reveal momentum. So I use the 20, or I should say the double zero, the 20, the 50, and the 80 pip levels to gauge momentum. Again, a little bit more price-based analysis, maybe a little bit more for those of you that have done intraday trading and watched the time and sales of level 2 in equities, or watched the dome depth of market expanded in futures. You might know what I'm talking about in terms of that order flow, in terms of that time and sales, and the way in which prices can stall, can reverse, or accelerate through particular levels. If you've seen that, then you know the relevance, especially of the double zero and 50, but also the 20 and 80 levels as well. Doesn't matter if it's pips, doesn't matter if it's ticks, doesn't matter if it's points. Okay? They have relevance. Of course, we're talking about the Forex market here, so we'll be speaking about pips. The final type of analysis is fundamental. Okay? And I'm talking about news, and I'm talking about events, both scheduled and unscheduled. Looking at the economic calendar, seeing what it's going to reveal about when there might be a more heightened sense of psychology. That's what it's all about. There's a more heightened sense of psychology around non-farm payroll. There's a more heightened sense of psychology around an FOMC statement or minutes. There's a more heightened sense of psychology during an ECB press conference, or when the BOE governor might be speaking, or when Spanish bond auctions go off like they did today. It's a heightened sense of psychology. Attention, uncertainty, and that all gives us that volatility that we typically see during fundamental events. Now, I mentioned respect all three. A lot of times technicians will ignore price too much. They won't look at the candle. They won't look at the psychology of price. Sometimes price-based analysis traders will ignore the value of understanding why a 200 daily moving average or a 50 daily moving average or a 20 could be so psychologically relevant. Even though it's a technical indicator, it has a lot of attention and therefore has a certain psychology it carries. Both technicians and price-based analysis traders will sometimes make fun of fundamentals. Call them funnymentals. I think once upon a time I was of that camp. They ignore the psychology that the economic calendar warns us of every single day. I consider myself a chart hacker. And that means, bottom line is, I respect all three. And I respect how all three can affect the market. So one of the top 10 mistake traders make most often is they don't consider all three aspects of what could be moving a market, because some days the fundamentals could be the mover. Some days it could be price. Other days it could be a 200-period simple moving average. Most of the time it's a combination of all three. But understanding which aspect of each is contributing to market movement, whether that be support, resistance, acceleration, reversal, whatever it may be, understanding all three and making that a part of your daily analysis really is very important. And oftentimes traders want to define themselves by the type of analysis they use. And I believe that oftentimes leads us to missing what the driver of the market is. Chart hackers always keep that in mind. What is driving the market? It's not the same thing every day. It's certainly not the same thing every day. Okay, let's move on to the next point. And that is choose a specific list of indicators and then stop looking. The shiny object syndrome is very, very tempting in the markets. I think a lot of times what traders will do is they'll typically gravitate towards whatever the hot indicator is at the time and use it. As if before the invention of or discovery of or popularity of that indicator, we were in the dark. Well, it's tempting as a trader when we're bombarded with so many systems and indicators and settings to think that somehow the missing piece of the puzzle is some specific indicator. For me, my specific list, for those of you that are curious, I use a MACD histogram to help me gauge momentum. I use a commodity channel index, a CCI, a commodity channel index, to gauge reversals. I use a slow stochastic to gauge overbought and oversold situations. And I have a number of moving averages that comprise my wave, as well as the very important to watch and aforementioned 250 and 20-period simple moving averages. Those are the indicators that I've chosen. It's not that the other ones out there aren't good, but these answer the questions that I have. Is there momentum? Is a market overbought or oversold? Could there be confirmation of a reversal? And where's the support and resistance? These are indicators. You can't watch all indicators. It doesn't mean that I don't think the Ichimoku cloud isn't good. It doesn't mean that I don't think an RSI is good. It doesn't mean that I don't think a Bollinger Band is good. Okay? It's just these are the list of indicators that I've found answer the questions that I have. And this kind of brings up the next point, which is traders must choose their strategies, and I mean entry strategies, based on the message of the market. Now, if that sounds like something you'd find out of a fortune cookie, well, let's talk about what that means. The message of the market really is market trends. Is the market going up, down, or sideways? That's got to be your first question. That's got to be your first question. And so that actually brings up a couple points. And I'll try to make this as connected as possible. Okay, so some of you might be saying, well, what is a market trend? And even if I believe that I need to know if the market is moving up, down, or sideways, I do that with a trend line, or I do that with a chart pattern, or I do that with an indicator. As long as you do it, I'm not here to tell you how to do it. I mean, we have plenty of video over at the IBFX YouTube channel that you can look at. For those of you that are familiar with my analysis, if you visit the daily Forex Trading Edge with any regularity, you know that I use the 34 EMA wave and my grab candles. Those are my tools. So, understanding before I even think about trading the market trend, not just of the time frame that I will want to trade, but of the overall market. So I think one of the biggest mistakes traders do is they ignore, they forget. This is a mistake, okay? I'm going to just put in here, mistake. They ignore Mr. Charles Dow. Charles Dow probably had the most profound influence on the way that I analyze the markets, because he somehow was able to put in my head, my thick skull, the importance of understanding that price reflects psychology. By the way, you'd think it'd be kind of easy to type and talk at the same time. It is remarkably difficult. So price reflects psychology. What is an uptrend? Ultimately, what is the mechanics of an uptrend? We could say is a series of higher highs and higher lows. Higher highs being the mojo or the momentum, the attention grabber of the uptrend, and the higher lows being the support or backbone. We can say an uptrend is greed. Okay? That's definitely part of the conversation. Definitely that whole idea of making sure that when you look at a market, you understand that it's people that are moving it. You understand that it is people who are feeling that Apple or the euro or the yen, whatever it may be, should be higher or lower, and they act on it. It's the action, right? Okay, we might have an opinion in the market. There might be a sentiment. Momentum is the beginning of that sentiment in being realized. And then ultimately, if that sentiment and momentum continue, you have a trend. That's the bottom line. So if I ignore Charles Dow, I forget then that price reflects psychology. It's as simple as that. All right, I don't want to complicate that. And that's, again, if you look at Dow theory, it will make a lot of sense as to the four, and I say four because really he had uptrends, he had accumulation, and he had distribution. The stock market has a bullish bias, so he doesn't talk a lot about downtrends. But he talks about what the psychology is and the phases or trends of the market and what the underlying psychology likely is as the market's moving in a narrow sideways trend or pushing to higher highs and higher lows or in a wide volatile chop. Okay, he talks about that. So if you ignore Charles Dow, that means you're ignoring the market trend. So it's kind of tied up to number 3. Okay? So next point, and I just want to keep putting little notes here as we have discussions, and if you have any questions, please feel free to ask. Okay? Relating to traders needing to choose their strategy based on the message of the market, most don't. Most just, and by the way, what do most traders do? Let's talk about this for a moment. Let me elaborate on this for a moment. What do most traders do? They define themselves, okay, they define themselves by their strategy. I hear a lot of traders tell me that they're swing traders. So that basically means they're going to use a particular strategy and apply it to all markets. Okay? As far as Dow theory goes, one of the best ways to just kind of get a good overall glimpse, overall discussion, actually Wikipedia has a great little description of Dow theory. So if you go to Wikipedia, there's a great discussion about Dow theory there. It's very succinct. It'll give you some good insight. So you can just go to Wikipedia and look up Dow theory. Okay? So going back to this, most traders will define themselves by their strategy. They'll say, I'm a day trader. They'll say, I'm a swing trader. They'll say, I'm a position trader. And whatever that means to them, and whatever tools they feel they need to use to accomplish those types of trades, is what they'll apply to all market types. Well, I'm here to say, instead of saying, I'm going to use a swing trading strategy on the market all the time, how about reversing that and saying, what environment should I be swing trading in? What environment should I be short-term or day trading in? There is value to every type of strategy. Anyone who says day trading's bad, well, that's not a fair assessment. For some traders and for some account sizes and for some risk tolerance, day trading is perfect. For other traders, swing trading is great. Okay? For some traders, momentum trading. It suits their personality. The same thing can go to time frames as well. So if you ask yourself, and some traders like trading a range. They like fading or trading a range. Range-bound trading. Okay? I'm not here to say any one is better than the other. That would be, well, arrogant, and that would be wrong. Different types of market environments and different types of price movement can lend themselves to one or many different types of trading depending upon the time frame and your risk tolerance. Ultimately, the decision should be, really one that's personal. If you don't like, or if you find yourself not liking longer-term markets and sitting through corrections and taking a lot of heat, longer-term time frames and a longer-term strategy may not be your thing. Okay, but if you like getting in and out of the market, not holding a position for very long, playing intraday momentum, being flat at the end of the day, there's certain things that you need to know about you, and that will help you to find what trading strategy you might gravitate towards. But then ultimately, you still need to know when it's appropriate to use those strategies. Here's a point. Trend trading, or trend following. I love trend following. I consider swing trading to be my trend following strategy. But if there's no trend, if the market is in a chop, why would I apply that strategy to the market? Does that make sense? So, ignoring Charles Dow and not understanding the underlying market trends, not understanding that the price is a reflection of psychology means you're ignoring market psychology. You have to know whether or not traders are willing to take on risk, if they're risk averse or if there's risk appetite. You got to know whether they're willing to support pullbacks. Every time the market moves lower doesn't mean that it's a reversal within the context of a trend. It could be a correction, one that people are willing to buy into. A pullback in a chop could actually be nearing an oversold status. So you got to understand what that move is within the larger psychology, which brings us to this point of or understanding what directional bias is. Now, a lot of traders will substitute their own, I'll define directional bias here in a moment, they'll substitute their own directional bias for the markets. Now, what do I mean by that? What is directional bias? And you might hear me refer to it as DB. Directional bias is basically, the way I look at it, there's two ways of looking at it. Some people have directional bias. If somebody says this trader has directional bias, they're actually saying this trader prefers to typically be long or typically be short. They like a particular direction in the market. Okay? That's personal or individual directional bias. But there's also the market's directional bias, and that's what I'm referring to here. And I'm talking about the dominant or overall psychology of the market. And I believe you refer to the daily chart to gather that information, to make that decision. So don't substitute your directional bias for the market's directional bias. Don't confuse your bias for what the market's trying to tell you. Let's talk about directional bias here, because every week I'll actually get into what will be a watch list. I create one of three watch lists. I create a watch list where the 200 DMA is in play. I create a watch list of what I consider to be fresh or just younger trends that are just in development, the early stages of development. And then I have a watch list for what I call the directional bias, which is essentially just more of an established trend. And I'll have these three watch lists. Now, my favorite watch list is the DB, or the established trend watch list. So I'll look for moves like this, where a market is on the daily time frame, showing that there is the organization of sentiment and momentum, which has developed in a trend. And within the context of that trend, my opinion is there's more likely to be support at pullbacks than all-out reversals. Now, if I'm looking at a market that does have a daily time frame that's in a trend, so directional bias is just really, if you want to break it down to something very simple, it's when the daily time frame has an up or down trend. It's really that simple. The daily time frame has an up or down trend. So here I have a directional bias of the euro-US dollar, and one of the things that directional bias helps me out with is that it will tell me, it will guide me as to which time frames I'll focus on and whether or not that time frame is setting up a trend following or counter trend trade. So if I've got a bullish directional bias by way of an uptrend on the daily euro-US dollar, or north of the 200 period simple moving average or 200 DMA as well, I know that any long position is trend following. Even if it's on a 5-minute, I'm following the dominant psychology of the market. Any short position would be counter trend. So if I am looking at a trade that would put me short, I'm actually then going to limit that. I'm going to limit a short position to the 5, the 15, or the 30-minute time frame. I don't want to be swimming upstream fighting the trend on a longer-term time frame. So for counter trend, in this case a short position, I'm going to focus on the short-term time frames. In other words, there will be opportunities sometimes to be short the euro-US dollar. But if I want to capitalize on those, I want to be nimble about it. I want to realize that I'm swimming upstream. Okay? So because of that, I'll focus on a short-term time frame. And I'll look for opportunities to short based on those, knowing that it's more likely at some point that the dominant overall psychology, that directional bias, is eventually going to win out and the bulls will regain control again of the market, in this case of an uptrend. If I'm looking at a downtrend on the flip side, say one on the dollar Canada, where I actually have a short position, on a rally such as this, and here's an example of a position that I took based upon the fact that, one, I have a bearish directional bias, so I'm not substituting my own opinion or any kind of opinion of mine for what the market is telling me. The market is telling me, with the culmination of these successive red grab candles and the angle of my wave, that I've got a downtrend. Following that trend would mean setting up short positions. So even when I have some sort of position that might look like it could be giving me a buy, and let's jump on over to view that here. Let me refresh the chart. So if I'm looking at a position that could give me a buy within the context of an overall downtrend, I'm going to remember that I should ideally limit them to the 5, 15, or 30-minute charts. Again, anytime I'm going to be long with the overall trend being down, I want to be nimble. I don't mind being long, but it is and then being counter trend, and I'll do it short term, 5, 15, 30. I'll sometimes make an exception for the 60, but not very often. Okay? I'll typically want to stay nimble. So again, I'm not going to substitute my own bias for what the market's telling me, and I'm going to determine what the directional bias is of a market by the daily time frame. Okay? So a couple other points here, and this is, now we're kind of leaving this directional bias conversation, and let's get back on over to our notes here. So another mistake I see traders make is they ignore time, or worse, they treat all hours of the day the same. I should say, really, in many ways, ignore time differences. And what I mean by that is, if you are looking at, for example, there's 2 prime time hours of the day that I focus on. Okay, I'll explain why I consider them prime time. I look at the 8 a.m. Eastern to basically 11:30 a.m. Eastern. Time is 1 prime time. Essentially because who's opened between 8 a.m. and 11:30 a.m.? Who's awake and trading during this time of day? Who's awake? Paris? Yep. Frankfurt, definitely. London, absolutely. New York, you got it. I've got 4 major financial centers all open and operating and trading at the same time. That overlap, that 3.5 hour overlap until the European close at 11:30 a.m. Eastern. That's about as firing on all cylinders as the market can get. I typically will not wake up at 2 a.m. to trade Paris and Frankfurt. I know it's important if I'm trading a lot of cable, if I'm trading a lot of the cable or really any pound sterling pair, I might. But really, your most volatile times of the day, and we've discussed this, if you use the auto chartist power stats, you know this, okay? If you've watched my past webinars on this topic, you know what I'm talking about when it comes to time. And I could do an entire presentation just on this aspect of the market alone. Understanding time, understanding volatility, understanding price movement ranges. Auto chartist does it for you. So if you're not using auto chartist, I would definitely recommend using it, because if you ignore time, you're not understanding the difference in volatility. For example, right now, it's 8:30 p.m. on the East Coast, and I'm in the heart of the Asian session. Well, even when the Asian session has full participation out of Sydney, Tokyo, Hong Kong, and Singapore, it doesn't come anywhere near the type of participation you have with Paris, Frankfurt, and London, or Paris, Frankfurt, London, New York. The volatility is different, the price movement is different, and that then leads to different types of risk-reward situations, different expectation for follow-through. Okay, the whole market behaves completely different. Yes, there's 24 hours in a day, but they don't all behave the same. And that's something that a lot of traders overlook when they become Forex traders. They think all 24 hours behave the same. They look at the type of price movement between, say, 8 a.m. and noon, Eastern Standard Time, and think that's the kind of price movement they're going to see 8 p.m. to midnight. And that couldn't be further from the truth on most pairs on most days. Okay, so if you ignore time, it's a huge mistake. We do have a way we can measure and gauge it, and that's the auto chartist power stats. You get that, I believe, free as an IBFX client. So definitely a tool that I would recommend everybody take advantage of. All right, so let's move on from there. We don't want to ignore time. The next thing to discuss would be in terms of time, and I think this is very much related to the time discussion, is a lot of traders won't take the time. They don't get to know a pair before trading it. Now, what do I mean by that? Well, the auto chartist price movement range is part of it. Price movement ranges, it's huge. Okay, understanding time, that's part of it. Understanding your cost per trade. We know that all pairs have the same spread. So understanding your cost per trade, when that spread might widen. Okay? Understanding the typical price movement range, the time and the cost per trade will give you a much better idea of the kind of volatility you could see, when you'll see follow-through, and when the market will be slightly more risky. You know, typically speaking, the Asian session's quieter. Doesn't mean it's less risky, but there's less price movement, which in some ways does minimize risk. The time between, say, 8 and 10 is oftentimes the most volatile for almost every pair. I say almost. You should really look at the individual power stats for every pair, but for the most part, generally speaking, 8 to 10 is some of the most volatile hours, because you have the prime time of Paris, Frankfurt, London, and New York. You have some of the most impactful pieces of data hitting the market, whether that be ECB, whether that be U.S. data. So you have to know what you're dealing with in terms of time, and part of that is getting to know a pair before you trade it. When are the volatile times? You know, if you look at a lot of pound sterling-based pairs, the 2 to 4 a.m. time is almost, very nearly, sometimes more so, volatile than 8 to 10. So each pair has a rhythm of its own, and that's a big lesson here. Take away. Okay? Each pair has a rhythm of its own. And you should know it before you trade it. You should know that rhythm before you trade it. All right, so we're getting down to the last handful of mistakes I think traders make, things they overlook. Okay? Another one is not considering what has already been discounted. What do I mean by that? I find this one to be the most amazing because, especially newer traders, okay, not considering what's already been discounted, I think a lot of traders think in terms of news that they're somehow at the top of the totem pole, or that in terms of data, they'll be able to execute their trade quicker than anybody else. Or in terms of research, fundamental research, they've discovered something nobody else has. Most of what's already out there is already known. You're not going to uncover something new. You're not discovering the new world. And that's okay. That's okay. But don't think you are. Remember, most of everything that's out there, outside of data, okay, outside of the actual result of data, almost everything out there has been discounted, which is just another way of saying it's been considered, or as you probably heard this saying, baked into the cake. We already know it, or we have some sort of expectation, and we've responded or traded accordingly. Traders have made their bets. Okay? So, if it's breaking news, it's very unlikely you're the first one to hear about it. Data is a little bit more of a level playing field, but very seldom are you going to be the one that's going to be first to get that trade in. And you got to remember, unless it's something that's completely unscheduled, geopolitical events, geological events, okay, unless it's something that was completely unscheduled, completely unseen, and sadly those are usually tragedies. But unless it's that kind of event, there's been some sort of discounting, some sort of assumption. This is where that whole saying of buy the rumor, sell the news comes from. Okay? We react to what we think is going to happen. Okay? So buy the rumor, sell the news simply is baked into the cake, discounting in action. We have an opinion, we trade according to that, and then when we get the actual result, oftentimes we'll be responding to what our expectations were against what actually happened. Let's use the economic calendar for a moment. Does 1.9 on the Philly Fed manufacturing index mean all that much? Well, if you're talking about PMI index, these releases, we know that 50 is a big line in the sand. But does 1.9 on the Philly Fed mean all that much? In and of itself, really not at all. But when you factor in that traders were expecting this number to come in at 4.1, these are both just kind of random numbers, but they're measurements. I was expecting 4.1 as a measurement, and instead I got 1.9. If this 4.1 is discounting a lot of pessimism and or fear or a bad result, and I got something that was less than that, it's better. Like unemployment claims. If I expected 374,000, but I got less, that would be better. If I was expecting 374,000 and I got more, like we did today, that's worse. How much better, how much worse, how we gauge the reaction has a lot to do with what we discounted, what the consensus was, what was baked into the cake. So to respond to 1.9, negative 1.9, without understanding negative 1.4 was the expectation, you're not looking at the full picture at all. That's why I say a lot of new traders don't understand or don't consider that typically much of what they see in terms of news and in terms of data has already been discounted. There are very few events that we all are privy to at the same time. Very few. Okay? So you have to think about what's already been factored into the market. Some of you might be saying, well, Raghee, how do I do that? A really easy way to do that, I do this every morning in my chat room. I go in and I do Google News searches and I scan headlines. Really that simple. I scan what the current headlines are in the market just to see what the tone of the market is. Is it mostly negative? Is it mostly positive? What are the buzzwords? and I'll skim that. It's a terrific way of understanding what the psychology is in the market. So I will go into Google News and do a search like that. I'll look at the economic calendar. I like the one at Forex Factory a lot. I'll understand what the consensus is much ahead before the data is released. And I'll make some decisions about what's been discounted. And then that way, when I get a 1.9, I know what that means. The consensus, the forecast, gives it context. Okay, without that, there's no context. All right, next point. As we move on from not considering what's already been discounted, we're getting down to our last 2 points here. Most traders don't define what a winning trade is. Now, this is a huge discussion here, gang. In fact, the last two I kind of hesitated to even include because this could be a discussion in and of itself, to be quite frank. And maybe one day it will be. How do you decide what a winning trade is? Is it the first time you go black? You know, you look and you say, oh, I'm finally covered the spread. Is it 10 pips? Is it 20 pips? I'm not here to tell you what you should be doing. But I am here to say, I'm not here to tell you that, whatever methodology you're using, you have to have one. That's what I'm really imploring you to do here. How do you define it? How do you define what a winner is? No one teaches us that. I mean, is it 10 pips? Is it 20 pips? Is it a percent? Is it a psychological level? Is it near-term support or resistance? I mean, those could all be potential choices. But how do you define it? Because if you have a winner, at that point, you go and you execute that old saying. Don't let a winner turn into a loser. Which means there's got to be some mechanics, some order entry mechanics that follow that. What do I mean by that? Well, if I know that after whatever that level is, 10 pips, hitting a major psych level, a certain near-term high or low, once I've hit that level, I should then immediately take myself out of a risk situation, which means once I've hit my initial profit target, whatever that may be, I should at very least move into a break-even scenario. Because if I don't, and the market moves against me and hits my stop loss, my risk-based point of validity stop loss, I've just let what I once called a winner turn into a loser. The only way to prevent that would be once you hit that profit target, your initial profit target, and you should have a couple of them. Every trade should have multiple profit targets, especially if you're a multiple lot trader. Once you hit that initial profit target, you should go to a break-even stop loss. So if worst comes to worst, you've realized a profit on some of your position, and if everything were to come back to you, it basically would be the loss of the spread type situation. It's pretty much a minimal break-even scenario. So you have to define, in order to execute your trade management, you have to define what a winner is. And that's where your profit target is. And if you don't know where, and by the way, also related to this is, if you don't know where your winner is, okay, I'm hoping you know where your stop loss is before you get into a trade, but if you don't know where your profit target is and your stop loss is before you get in, okay, how do you know what your risk-reward ratio is? And how do you know whether or not the trade is even worth the risking of your capital? If based upon support and resistance, I can't at least have a 1-to-1 risk-reward ratio, not based upon my hoping that the market will go 40 pips and I only want to risk 10, that's make-believe. Based upon support and resistance, based upon price movement, based upon volatility, I can look to the auto chart as price movement range, historical likelihoods, but if I can't at least have a 1-to-1, I have to have at least a 1-to-1, otherwise why would I risk more than I could possibly make on that initial profit target? Doesn't make sense. Now some of you might say after all that analysis, I want at least a 1.5-to-1, or 2 to 1. That's fine, but don't manufacture these. What I mean by that is, I've heard many people tell me their trading plan is, I'll risk 10 pips to make 40. Where is that based in reality? Where is that based in the volatility of the pair? Where is that based in the understanding of time or the price movement for that pair? Where is that based in the realistic nature of the support and resistance on the chart? Okay? So that's why I say I want to use what's real, or at least what's most likely, to gauge that risk-reward ratio, that support and resistance. Okay? All right, and finally, this is probably the most controversial that I'm going to put out here. And this is, a lot of traders don't understand what a stop loss is. I know that sounds kind of crazy, but they don't understand what that is. I'm going to tell you what it means to me. You guys can think I'm crazy, but I'm going to share with you all I can share, which is what I do day in and day out when I'm trading. A stop loss, of course, is that uncle point, the point at which I say, I'm wrong, and the trade is no longer valid. Notice I didn't mention a dollar amount or a percentage, simply where the trade is no longer valid. To me, a stop loss, of course, is where we stop the loss, stop the financial loss, stop the loss of our capital, of course. But it's a tool that's initially, when you're considering this initially, it should be a tool that is meant to identify where you're wrong, where the trade really has no business being open anymore. Dollars and percentages are random. They're great guidelines. Don't get me wrong. I'm not saying dollars don't matter. I'm not saying that at all. And I'm not saying, say, a 1.5% or 2% stop loss or uncle point isn't at least a good guideline. But it doesn't mean it's your stop loss. Okay? I have some trades where I might risk 50, 60 pips because that's where the next level of support is for a buy. I have some, especially when I'm doing distribution fade type entries, where I'm risking 10 pips. Not because I've imposed it on the market, but because within 10 pips I might move outside the range of what should be an exhaustion level, and I could very easily teeter into momentum and be on the wrong side of the trade. So it isn't random. It's chosen based upon what it is that justified the trade to begin with. It's not dollar-based, and it's not percentage-based, although dollars and percents could help guide me into determining whether or not that stop loss or even that trade is affordable. You know, what a completely different question. Okay? But a stop loss is where the trade is no longer valid. It's not just where you say, I don't want to risk any more money. Because if you impose super tight stops or unrealistic stops that don't respect the volatility of the market, the time of day, and the typical price movement range of that pair, you could consistently find yourself being stopped out only to see the market move in your favor when it turns around, because you didn't consider the market's message, the pair's personality. So that one's probably the most, I would admit, controversial. I do my stops very differently. I don't believe it's simply just some dollar-based number I put out there and randomly impose upon the market. I think the reason I use charts to get into the market is because it leaves, the charts like breadcrumbs. It tends to reveal tendencies and decision levels and volatility. And if I'm getting into the market, if a trade is set up with these highs and lows all over the chart, why wouldn't I still rely on those to get me out? For whatever reason, we rely on the charts and price to get us in, yet we throw it out the window oftentimes when we set up a stop loss. We start using percentages and dollars that we want to put at risk. When in reality, whatever methodology I use to get me in, whatever mindset, whatever tools, I should stick with those to get me out. At that point, again, I can step back and say, and this is it's an important question, after all the work, after all the charts set up, you ask yourself this very important question. Is this trade affordable? I've set up a lot of trades, And at some point when I step back, I go, oh gosh, that's a huge risk that I'd have to, manage or accept if I want to take this trade. Maybe I don't want to. Is it affordable to trade non-farm payroll? For most traders, I'd say it's a resounding no. Is it affordable to trade FOMC statements or ECB press conferences because of the volatility? These are questions you have to ask. It's not just about what you see in the charts, but also what could happen based upon time and the economic calendar. So you kind of see all these 10 points are kind of wound up together. You don't disconnect them. They all kind of lead you to ultimately a decision. Okay? So I hope this discussion, I know it was in some ways probably just the beginning of the discussion, not certainly giving you all the answers, but to me, part of trading is starting to ask certain questions and then start learning how to answer them. Now, asking them, we could do in a quick webinar like this. Answering these questions could take the rest of our lives, literally. I'm still finding better ways to answer these questions. Even 20 years after I first started asking, I'm still looking at ways to answer these questions. So hopefully this will begin the discussion, begin the debate, and you can start asking these types of questions and thinking about some of these points before you put on your next trade. Okay? Again, I'm Raghee Horner, the Chief Currency Analyst for IBFX. I'm thankful and honored you made time out in your day to sit with me here for about an hour to discuss the markets. You can catch my analysis over at the Daily Forex Trading Edge. Thank you so much for attending this discussion. It has been recorded, and it should be available later on over at the IBFX channel at YouTube, which you can check out over at, I believe it's www.youtube.com, and I'm going to push this link through here on the chat. Interbank FX videos. Again, www.youtube.com/Interbank FX videos. Okay? Videos. All right. So that is the discussion tonight. I appreciate your time. Tomorrow what I'll do is I'll go ahead and post these notes for those of you that want it. There's a site that you can post notes at, and you guys can download it from there. I'll do that tomorrow. So I'll save this, and then you all can check download it tomorrow. Go to the Daily Forex Trading Edge tomorrow, and I'll have the link there on whatever my most recent analysis is. So you can check that out tomorrow if you'd like. Okay, thanks again for your time, and I will see you in the next presentation. Take care, everybody.